The Wall Street reverses last week's losses with the sensex and nifty rising 2% each. The broader markets outperformed. So in this week's edition of Editors Roundtable, we decode all the action from the Wall Street. We talk about the big promoter stake sales which continue through 2024, and we'll also put the spotlight on the action in the commodity space. I'm Reema Tendulkar. With me are Nimesh and Prashant. And joining us on the show today, let me welcome Harsha Upadhyaya, President, Chief Investment Officer for Equities at Kotak Mahindra Asset Management. Harsha, thank you very much for joining in, and hi boys.
Hi.
Guys, hi. I think
Thursday. We have to have one day in a week which just zaps everybody, right? And that was this Thursday, weekly expiry day. Yeah. And what a move, 408 points in a single day.
In 1 hour, one and a half hour.
And on a day when, the calls, Prashant highlighted in the morning as well, some crazy moves, right? Half a paisa call moved to 120 rupees and all. I mean, that's the kind of market we are in. And on the same day, we saw the FIs having the highest weekly inflow on one single day, which is of close to 5,000 crores. I'm excluding the block data, and still then they've put in 5,500 crores in a single day, which has been after a very long time. So, yeah, I mean, bulls are having a great time.
I was actually going to say that I think last week or one of these days you had three of us, right? Yeah. And somebody sent Nimesh a picture saying it's a where is the round table? It's a triangle. So I think if Harsha was with us here, we could have probably. But it's I think this week, coming week is going to be important and interesting also, right? Because all of us have been sort of beating the drum when will rates come down? Not just us. I mean, companies we speak to, fund managers, everybody's been saying. We've had rates go up from 0 to 5%. Now, ulti ginti kab shuru hogi, which is, I think it starts next week. Yeah. And I think I just want to quickly put out a few points. I think everyone is pretty well aware. It's very, very well advertised. The only now question is the rate cutting cycle will begin next week. And I think that's going to be the big talking point and can't get away from it. And you can call it in anticipation or whatever. But the point is markets globally, you look at India, you look at the US, markets have really squeezed back to the higher end of the range, which means in India, we've basically gone back to all-time highs. In the US, we're not again very far away. You can say broader markets, etc., nowhere there, but the large caps, right? The large cap indices have done that. And you look at other markets as well. So risk has really come back in a very strong fashion as we go into this important, the first sign that interest rates are going to start to come off. I've often wondered, if higher rates have not hurt markets, what will lower rates really mean? Can it provide another?
It could be reverse, right? I mean, we saw every market going up in the up cycle. Yeah. And we had in history as well that whenever there has been rate cuts, over a period of time, maybe a couple of months we can't count, but in general, we've seen a sharp correction in the markets after the rate cut. So maybe,
the
again,
interpretation is that, rates only go up when the economy is strong. Yeah. But sometimes rates this time went up because inflation was too high, right? And so we'll see. So Fed will cut rates on Wednesday, which we'll react to on Thursday morning. I just want to put out this interesting thing, right? Is it going to be, why are we saying whether it's going to be 25 or 50? Because last night, there were two articles, one in the Wall Street Journal and one in the Financial Times, both sort of putting the question whether it's going to be 50, it could be 50, whether 50 is still on the table or not. Now, some are saying, well, this is not a coincidence. This is the Fed telling the market and saying that, well, it's possible it's 50.
Preparing the market.
Or as somebody messaged me earlier saying, well, this could be the market hustling the Fed to do a 50. Correct. So it's possible. We don't know. But it's very much alive. That's the point that I'm making. And if they start with the 50, that's a big one. The general understanding was that 25 is better because 50 would mean that the Fed knows something more, which is that, maybe the economy is not such a good shape. It's more like an emergency cut. But we'll see. But in any case, because markets, as I began by saying, have done so well, and all this talk of 25 and 50 has come in as well, that decision itself becomes a bit of a high volatility day. Because now is it going to be a miss? Is it going to be a beat? Is it going to be in line with expectations, etc., etc.? And of course, there is the whole market reaction after that. So, interesting times in that sense. Let's bring in Harsha with a quick view. Harsha has been, of course, cautious. He's used various examples, both here and locally, to sort of forcefully make his points, I should say. Harsha, where are you at as far as markets are concerned? And how will rate cuts, what will they mean for financial markets?
Prashant, in terms of rate cuts, I think more or less the consensus is there is going to be a rate cut next week, and most likely it is going to be a 25 basis points of cut. So to that extent, I think market is prepared for an interest rate cut. And in the run up to the likely interest rate cut, we have seen markets also doing very well. So clearly the undertone, not just in Indian markets, but across markets, as you were highlighting at the beginning of the show, it's been very, very positive and bullish. Yes, valuations have moved up, have continuously been on the higher side. So to that extent, yes, one needs to be cautious, but I don't know what is the trigger which will make the markets to realize that we are at a high valuation at this point of time, given the kind of strength that we are seeing across markets.
Harsha, we already gave you your cue. Next time, you've got to join us here in the studio. We can't have this triangle going for us.
Yes, I heard that. I'll be happy to.
All right. So how are you positioning yourself, considering valuations in so many pockets of the market are very high? What are the changes that you've made in the last few months?
Rima, as I would have spoken earlier as well, we do not keep too much cash in our portfolios. So we generally do not take active cash calls. So our cash levels are minimum just to manage our daily liquidity and a little bit of portfolio revamp. As far as we are concerned, we have been booking profits in segments where we believe valuations are on the higher side. And also there are some slight negatives that are ahead of us in terms of fundamentals. For example, in the auto space, we have cut some weight over the last couple of months, especially in the passenger vehicle segment, where we are seeing inventory building up and also discounts going up in the market. And we also believe probably we have seen best of the margins for the sector. And the sector has outperformed during financial year 23 and 24. We believe that 25 may not be as good as what the market anticipated initially. So we have cut some positions there. We have also booked profits based on higher valuations and how recent outperformance has been in sectors like defense and industrials. So the money that we have raised from booking profits in some of these sectors that I mentioned have gone into slightly defensive-oriented sectors such as consumption and IT, I would say, where immediately we may not see a jump in earnings growth trajectory, but at least the valuations are not as expensive as some of the sectors where we have booked profits from. So overall, slightly more defensive approach in the portfolios, I would say.
Okay, so some profit booking in auto, industrials and defense, and money. That money has moved into FM consumption and the IT names. But Harsha, hold that thought, because this is the year where we've also seen record promoter stake sales. Nimesh, give us the numbers.
Well, Rima, it's a record year for across, right? I mean, markets are at all-time highs. Commodity gold is at an all-time high, and so is the promoter stake sale as well. So I'll just go to the wall and explain. But personally, also it's a high for me because I've completed 19 years this month in CNBC. Yeah, so
incredible.
Anyway, let me just go to the wall and explain what the promoters and PEs have done in 2024. It's a kind of a record year, so to speak, in terms of the stake sale that the promoters and PEs have done this year so far. Okay, this is the big number that we're talking about. 4.75 lakh crore is the total amount of stake sale which has been done, promoters, PEs as well as non-promoters. When I say non-promoters, someone like BAT gets included, where they sold 4% stake in ITC this year. So this has been the trend. In the last 3 years, it's been around 3.2 lakh crores. This year, Y2D, it's still 3 months are left, and we've already crossed 4.7 lakh crores. So maybe by end of the year, we'll be crossing 5 lakh crores in terms of the total stake sale which has been done by promoters, PEs, as well as institutional investors. So that's the kind of trend we've seen. Now, the big deals which have happened this year, of course, Interglobe Aviation tops the list. There were 2 large blocks by the Ganwal family. They've raised close to 17,000, almost 18,000 crores. Indus Tower was another large block. Vodafone sold a big stake and raised 9,000 crores in a single day. Emphasis, big block by the PE investor, and they raised close to 7,000 crores. And even in Bharti Airtel, the PE sold close to stake worth 5,800 crores. So these were the large deals which have happened this year. Vedanta, Ambuja Cements. Whirlpool was interesting. The parent sold a big chunk, 24% stake in Whirlpool India, and they rose close to 3,800 crores. So these were the top 10 deals in terms of size that I'm talking about, which has happened this year in terms of the promoters and PE stake sale. It's been a record year in terms of OFS and IPOs as well. I'll talk about the OFS first. In the OFS list, of course, the government, government companies top the list. Hindustan Zinc, there was a large OFS of 3,000 crores. NHPC and NNC India were the other two PSUs where the government sold via OFS, and they raised close to 2,400 crores. Aditya Birla Sun Life was another company where the promoter sold via OFS. They raised close to 1,500 crores, and Glenmark was another deal. So these were the few large OFSs. Now let's come to the IPOs. It was a record year for IPOs as well. 15,000 crores plus, and we are still counting in for this year. Hexacom was the biggest IPO for this year. In April, they raised close to 4,200 crores. Aadhar Housing, Go Digit, Medi Assist, Eco Mobility. There were a lot of smaller companies as well, which have raised between 600 to 1,000 crores or 1,500 crores in this year. Gopal Snacks, Entero Health, Allied Blenders. The list just goes on. I've just picked up above 500 crore fundraising in the IPOs as well. So, as I said, it's been a record year as far as the Ps and promoter stake sale. Almost at 5 lakh crores is what we've reached Y2D this year, and it's been a record year. So, Harsha, if I want to ask you, I'm sure you would have participated in some of those blocks as well. It's been kind of a, wealth shifting from promoters and PE investors to locals now through mutual funds, of course. What's been your call on the promoter stake sales, and have you participated in many of them?
Nimish, yes, I mean, there have been so many deals during the year. Definitely, we would have participated in some of them at least. And yes, we have participated. And your data also includes a lot of IPOs that have been come and gone during the year. So we definitely would have had some interest in some of them. But just a little different thought here. Maybe you need to bifurcate this number into two buckets. One where it was IPO and a growth capital that was raised, which would have happened in any case. So that we should probably keep it aside. And also in terms of the PE exits, there are two kinds of exits. One who are exiting because there is a higher valuation and they believe that probably this is the best time to exit. And also there are private equity funds which are exiting because their funds are coming to a closure, right? So that's anyways mandatory to sell off at this point of time. So even if you make these distinctions, you would probably see a couple of lakh crores of promoters and PE, which is sold on a voluntary basis. And that's where it begs a question, whether the public shareholders know more than the people who are actually running the company or not. Only time will tell. But today it seems like even those stake sales have had very little impact on the market. And probably the valuations have increased even after all of those offer for sale and various stake sales.
Harsha, maybe because some of that money is coming back to fund managers, right? Probably to you. It's coming back into the market,
right? Through, of course, through family offices and putting money into mutual funds.
Yeah, maybe it's getting a little diversified. Yeah.
Away from just one single stock, right? I mean, the company you already own. Investors likewise. It's interesting, Nimish, you started with 2020, right?
Yeah.
20 is when I think we got the string of deals. It was 2021, the deals.
21, 22 was when we saw, which is why,
back to back all those deals which happened.
So 21, 22, 23 was average.
I thought it was 2020.
I thought it was 20 when...
It kicked off in 2020, went into all the way to 21. Maybe, yeah. That actually was the in a way, it kicked it off, right?
Yeah, absolutely.
And it's we've not looked back since. Depths of COVID, and I think the number for 2024 Nimish sort of put out is literally double of what we saw back in 2020. Well, we'll take a quick commercial break here. We're going to come back and we'll look ahead into the new week. We're going to also ask Harsha about a few sectors, jewelry stocks, Bajaj Housing. Rima will sort of talk about this one in greater detail and more. Stay with us. Welcome back. You're with us here on Editors Roundtable. And, we've been talking about stocks and, globally what stocks have done. But commodities is the other piece of the pie, which has done phenomenally well. I was looking at data, Rima, from the 5th of August, that panic low. I was looking at asset classes and commodities, and gold in particular has done phenomenally well.
Oh, absolutely. But let me start with crude, because that stole the spotlight at the beginning of the week. On Tuesday, Brent crude prices slipped below $70 per barrel at a 3-year low. So that was the headline. Brent crude below $70 per barrel. After that, it recovered through Thursday and Friday, and for the entire week, crude prices did end with gains, and there were many factors at play. So, for instance, OPEC cut the demand forecast for the second time in 2 months. There's weak Chinese data, which hurt the sentiment. The transition to EVs and cleaner fuels is also hurting demand. But then on Thursday and Friday, with that recovery, it was also Hurricane Francine, which impacted supplies. But on Friday, we had gold prices going on to hit record high levels. So the international spot gold prices crossed 25.60 an ounce. And the low earlier this year was about sub 2,000. So it's been a fabulous move. And I was just checking the annual return in the Indian currency for the MCX spot Indian price. In the last 9 years, there's only been 1 year where gold has actually given you a negative return. Other than that, in 8 out of the last 9 years, gold has actually given you a positive return. And if you look at the CAGR, 5 years, 10 years, they've actually matched that of equities. So jewelry companies did very well. So this week we had a near 40% plus gain on TBZ. That's Tribhuvandas, Zaveri, Moti Sons moved up 35-40%. Kalyan Jewelers was a big one, a big double-digit up move. Senco, Titan also closing up in the green. So some of the factors driving the up move: 1, higher gold prices; 2, there is a PN Gadgil IPO; 3, many companies are talking about how the demand outlook, for the second half of the year is actually better than what they had earlier anticipated. We even spoke to CRISIL, and they said that, the weddings this year are turning out to be a lot bigger than what they were. So demand is, picking up on the sideline. But just bear in mind, as, Mangalam was telling us earlier, that most of the larger companies, like, say, a Titan, are fully hedged. So they may not benefit from the rise in gold prices, but some of the smaller mid-cap, small-cap gold jewelry companies could benefit because they've not hedged, so they can enjoy the rise that we've seen in gold prices. So commodities, both crude and gold, stole the spotlight this week. Harsha, do you own any jewelry companies, or at least the larger, large caps or the large mid-cap players?
Rima, yes, we do own some jewelry names in our portfolios. We have been positive on this space. I think clearly gold prices have been on an uptrend. And also one of the bigger overhangs that were there for the industry, which was about import duty, and that's also partially behind us. There is no reason to believe that there cannot be another import duty cut next year or in the next subsequent few years. But at least a large part of that cut has already happened. So whatever hit had to happen has happened. So at these prices, I think one can be positive on gold, and thereby I think the jewelry demand will also probably inch up. And anyways, as you get into second half of the financial year, you will see festive season coming up and a lot of weddings coming up. So overall, I think this space is going to really see better demand trends in the second half as compared to first half. And hopefully the stock should also do better than what they've done in the first half.
Harsha, what's your view on within financials on NBFCs and housing finance companies? We have a big listing on Monday in Bajaj Housing Finance, and the street is anticipating that strong listing would lift the other valuations of others as well. And also there's an anticipation of rate cut in second half, which could mean NBFCs could do well. Your view on both the sectors, NBFCs as on housing finance companies?
Between housing finance and NBFCs, we prefer diversified NBFCs, and they offer a lot more diversified loan book, as well as through cycles, they have done better than monoline businesses. And in case of interest rate trends and the likely impact on the lending businesses, clearly NBFC companies will have an advantage when interest rates decline. And we believe that in the second half, that's likely going to be the scenario. Although this time around, we may not see very sharp interest rate cuts in the country unless something unforeseen comes and hits us. But it's going to be a very shallow interest rate cycle. But nevertheless, it's going to benefit NBFCs. So to that extent, yes, we do hold some of the diversified NBFCs in our portfolio.
No, got that. So diversified NBFCs rather than sort of housing finance. And yeah, I mean, NBFCs are diversified. There's no sort of sector champion now. Everybody does everything. Harsha, on gold finance, you said valuations are now unpalatable, or you still like some of them? Just to complete that point.
Companies, I said...
Sorry, gold companies, jewelers, not gold finance companies, jewelers, yeah.
Yeah, on jewelers, we are positive at this point of time, as we believe the demand trends will pick up in the second half. And most of the negatives around the gold prices are also behind us, with import duty cut already behind us.
Okay.
Harsha, sorry.
You said IT and consumer were two pockets which you were comfortable with. In consumer, can you, what exactly were you talking about? Consumer discretionary?
Until very recently, we were overweight on consumer discretionary rather than FMCG or consumer staples. But of late, we have built some positions which are more rural dependent and mass oriented. We believe that the monsoon season has gone quite okay. And hopefully, with some lag, we should see pickup in rural consumption trends as well. So we have added some of the consumer staple names into our portfolio as well. So overall, on consumer discretionary as well as staples, now many of our portfolios have an overweight.
Just a quick word, pharma is not a part of your portfolio because pharma stocks have done very well. The earnings have been strong.
We do hold pharma as well. Pharma has been a good performer as well. And maybe a couple of quarters back, there was a lot more valuation comfort on the pharma names. And nevertheless, even now, we believe that earnings growth by and large should sustain, which is going to be slightly higher than what the market average earnings growth would be for this sector. So to that extent, we continue to hold an equal weight to slightly overweight position on pharma at this point of time.
Harsha, great conversation. Thank you very much for joining us. Enjoy your weekend. It's curtains down on another edition of Editors Roundtable, but next week is a big one, the Bajaj Housing Finance IPO and the Fed rate decision. Keep it with CNBC-TV18.